Imagine walking into a business meeting with your biggest investor. They've been pouring billions into your company for decades. They've built factories, created jobs, expanded operations. They're planning even more investment. And then, in the span of 1 year, they cut their investment by nearly half. Not 10%, not 20%, 45%. That's not a pullback. That's a vote of no confidence. That's capital fleeing. That's exactly what Germany just did to the United States. According to a bombshell report from the German Economic Institute released January 19, 2026, German companies slashed their investments in America by a staggering 45% during the first year of Donald Trump's second term. We're talking about $9 billion that was supposed to flow into the American economy, into factories, jobs, research facilities, technology, that simply didn't come. This isn't just a statistic. This is the sound of America's industrial base crumbling. This is the proof that Trump's tariff strategy isn't bringing investment to America. It's driving it away, and Germany isn't the only one running for the exits. Let's break down what the data actually shows, because these numbers are devastating. From February to November 2025, German firms invested around 10.2 billion euros. That's about $11.1 billion in the United States. During the same period in 2024, they invested almost 19 billion euros. That's a decline of nearly 45%. But here's where it gets even worse. Because investment flows can be volatile year to year, the German Economic Institute also compared 2025 to the 10-year average from 2015 to 2024. That average was around 13.4 billion euros. Even against that smoothed-out baseline, 2025 investment was down more than 24%. Samina Sultan, the researcher who authored the report, was blunt in her assessment. Even compared to this figure, there has been a decline of more than 24% since Trump took office. This isn't a temporary blip. This isn't a statistical anomaly. This is a fundamental shift in how Germany views the United States as an investment destination. And it's not just investment that's collapsing. German exports to the United States also plummeted. Shipments fell approximately 9% year-on-year from February to October 2025. According to the IW report, this is the sharpest decline since 2010, excluding the coronavirus pandemic. Think about that. The last time German exports to America fell this hard was during the 2008-2009 financial crisis, the worst economic collapse since the Great Depression. And now it's happening again, not because of a financial meltdown, but because of deliberate policy choices in Washington. The sectors getting hammered? The ones that matter most. Exports of cars and car parts fell by almost 19% over the period, mechanical engineering by around 10%, and chemical products by more than 10%. These aren't widgets and trinkets. These are high-value industrial goods. These are the products of advanced manufacturing. These are the sectors that drive economic growth, innovation, and high-paying jobs. And they're all in freefall. So what's causing this collapse? Trump and his supporters would tell you it's all about bringing manufacturing back to America. The theory goes like this. If you impose tariffs on foreign goods, companies will move their production to the United States to avoid paying those tariffs. Simple, right? Except that's not what's happening. At all. Instead, companies are doing the opposite. They're pulling back. They're canceling expansion plans. They're adopting what Samina Sultan describes as a wait-and-see approach. Why? Because Trump's trade policy isn't just protectionist. It's unpredictable. It's chaotic. And businesses absolutely hate uncertainty. Sultan explained that companies are particularly sensitive to uncertainty because creating or expanding production capacity requires planning years in advance. You don't build $1 billion factory on a whim. You don't hire thousands of workers without confidence in the regulatory environment. You don't commit capital to a market where the rules might change overnight. And that's exactly what Trump's trade policy has created. An environment where companies don't know what the tariff rates will be next month, let alone next year. When the fundamental assumptions of the economic environment are called into question, sometimes practically overnight, very few companies dare to make such far-reaching decisions, Sultan added. Let me give you a concrete example of what this looks like in practice. In October 2025, German exports to the US dropped 20% year on year. That wasn't because German products suddenly became inferior or more expensive. It was because American companies, the buyers of these German goods, didn't know if ordering from Germany would suddenly cost 25% more or 50% more, or if some new tariff exemption would make it cheaper again. So they stopped ordering, they waited, and German factories scaled back production. Meanwhile, Trump has repeatedly threatened and implemented higher tariffs, claiming foreign companies would establish or expand production in the US to circumvent the additional financial burden. But that calculation only works if the tariffs are permanent and predictable. If a company thinks tariffs might go away in 6 months or might triple in 6 months, it's not going to spend $500 million building a new facility. It's going to wait. And while it's waiting, it's also exploring other options, like investing in countries with more stable trade policies, like diversifying away from dependence on the American market. That's the uncertainty tax that nobody talks about. It's the cost of having an erratic trade policy. And right now, American economic competitiveness is paying that tax in full. Germany isn't alone in pulling back from American investment. What's happening with German capital is part of a much larger, more alarming trend. According to data from the Bureau of Economic Analysis, new foreign direct investment in the United States fell from $88.5 billion in the last quarter of 2024 to $58.7 billion in the first quarter of 2025, a 33.7% decline. But that's just the direct investment number. The stock market numbers are even more shocking. New foreign investment in U.S. equities purchased via the stock market and investment funds fell from $167.8 billion to $23.2 billion, an alarming 86.2% plunge. Total foreign investment in U.S. equities fell by $174.5 billion, a 62.5% reduction from the fourth quarter of 2024. Read those numbers again. Foreign equity investment in America collapsed by more than 60% in a single quarter. Now, Commerce Secretary Howard Lutnick has stated that President Donald Trump is committed to bringing in trillions of dollars in new investment into the United States. The data suggests the exact opposite is happening, and it's not just that new investment has slowed. As the National Taxpayers Union analysis points out, if current investment remains at the same level for the rest of the year, the United States will attract 45% less foreign equity investment than during President Joe Biden's last term. That's a massive loss of capital, and capital is what drives economic growth, innovation, job creation, and productivity gains. Think about what foreign direct investment actually means in practice. When a German company invests $500 million to build a factory in South Carolina, that's jobs for American workers. That's tax revenue for American communities. That's technology transfer. That's supply chain development. That's economic dynamism. When that investment doesn't happen, when Germany decides to build that factory in Mexico or Vietnam or keep it in Europe, America doesn't just lose the initial investment. We lose all the downstream benefits. The construction jobs, the permanent manufacturing jobs, the supplier relationships, the clustering effects that attract other businesses. We lose competitiveness. And in the 21st century global economy, competitiveness is everything. Here's the fundamental paradox at the heart of Trump's trade strategy. Tariffs on imported components and raw materials actually make it more expensive to manufacture in the United States. This is Economics 101, but it gets lost in the political rhetoric about protecting American jobs. Let's say you're a German automotive company considering building a new electric vehicle factory. You're deciding between locations in Alabama, Mexico, and Poland. If you build in Alabama, you'll need to import specialized components that aren't made in America: advanced battery cells, precision machinery, specific alloys. If those imports face 25% tariffs, your production costs in Alabama just went up dramatically. If you build in Mexico or Poland, you can source those same components without the tariff penalty. Your production costs are lower, making your final product more competitive in global markets. What do you choose? This is why tariffs on raw materials and imported components drive up the cost of producing goods in the United States, discouraging new international investment. But it gets worse, because tariffs don't just affect input costs, They affect the entire logic of foreign direct investment. As the National Taxpayers Union explains, U.S. tariffs and quotas that restrict imports leave our trading partners with fewer dollars to invest in our economy and to purchase U.S.-made exports. The more we import, the more dollars our trading partners have available to invest in the United States. The less we import, the less international investment we receive. This is the part that tariff advocates never understand. Trade is a two-way street. When America imports German machinery, German companies end up holding dollars. What do they do with those dollars? They invest them back into the American economy, buying treasury bonds, purchasing American stocks, building American factories. When you cut off imports with tariffs, you cut off that flow of dollars. You reduce the pool of foreign capital available for investment in America. It's a self-defeating cycle, and the consequences are playing out right now in real time. Germany's GDP stagnated in the third quarter of 2025 following an earlier contraction. Forecasts for the full year suggested zero or minimal growth, marking the third consecutive year without expansion. When Germany's economy struggles, German companies have less capital to invest globally. When trade barriers go up, they have less incentive to invest in the countries imposing those barriers. America doesn't win when its trading partners' economies suffer. We all lose. Let's drill down into specific sectors to understand just how badly Trump's tariff policy is hurting German-American economic integration. The automotive sector. This is where the pain is most acute. German manufacturers are heavily dependent on the American market. Volkswagen warned that tariffs could cost the company up to €5 billion in 2025. Its profits in the first 9 months of the year plummeted by 58%. During the same period, Mercedes-Benz saw its net profit halved, and Porsche recorded a dramatic decline in operating profit. These aren't companies that are giving up on America. Volkswagen, Mercedes, BMW, they all have significant manufacturing operations in the United States. They employ tens of thousands of Americans. They've invested billions in American communities. But when their profits collapse due to tariffs on components, they have less money to invest in expanding those American operations. They have to make hard choices about where to allocate scarce capital, and increasingly, they're choosing to invest elsewhere. Mechanical engineering. Exports of mechanical engineering products dropped by around 10% during the period studied. This sector is the backbone of industrial modernization. These are the machine tools, the precision equipment, the advanced manufacturing systems that American factories need to stay competitive. When American companies can't afford to buy German machinery because of tariffs, they don't suddenly start making that machinery domestically. They either buy inferior alternatives or they postpone upgrades entirely, falling behind competitors in other countries. Chemicals. Chemical product exports fell by more than 10%. The chemical industry is deeply integrated across borders. American pharmaceutical companies, plastics manufacturers, and agricultural producers all depend on specialized chemicals that often come from Germany's world-class chemical sector. Tariffs on these products don't bring chemical production back to America overnight. They just make American downstream manufacturers less competitive. What's particularly alarming is that surveys showed more firms planning budget cuts than increases, particularly in the manufacturing sector. Uncertainty in trade policy stifled spending. This is capital destruction on a massive scale. These are factories that won't be built, research labs that won't be opened, workers who won't be hired, technologies that won't be transferred, and all of it, is a direct consequence of trade policy chaos. There's a bitter irony in all of this. Trump's tariffs were supposedly designed to strengthen American manufacturing and make America more competitive. Instead, they're pushing one of America's closest economic allies, Germany, to become a competitor rather than a partner. Think about the geopolitical implications for a moment. Germany is a NATO ally. It's one of the world's leading democracies. It shares American values, strategic interests, and security concerns. For 75 years since World War II, the United States and Germany have built one of the most successful economic partnerships in history. German companies like Siemens, BMW, and Bosch have become American employers. American tech giants like Google, Microsoft, and Amazon have thrived in the German market. That partnership created prosperity on both sides of the Atlantic. It strengthened the Western alliance. It gave both countries leverage in dealing with authoritarian regimes in China and Russia, and Trump's trade policy is tearing it apart. As German economist Carsten Brzeski of ING argued, exports, once a reliable engine of growth, would not return quickly amid geopolitical tensions and supply chain shifts. Germany is now actively exploring new markets and reducing its dependence on the United States. Exploring new markets and strengthening domestic demand offer potential paths forward, became the mantra of German economic policymakers in 2025. That means German capital that would have come to Tennessee or Texas is now going to Vietnam or Poland. It means German companies are signing long-term contracts with Chinese suppliers instead of American ones. It means the deep economic integration that made the transatlantic alliance so resilient is fraying. And here's the kicker. Once those relationships are broken, they're incredibly hard to rebuild. If a German company spent 3 years building a new factory in Vietnam, it's not going to abandon that investment when Trump leaves office and trade policy potentially normalizes. The damage is long-term, possibly permanent. There's a massive disconnect between the political narrative around tariffs and what's actually happening in the real economy. The political narrative goes like this. Tariffs will force companies to build factories in America. We'll have manufacturing jobs come flooding back. We'll be energy independent, economically independent, and strong again. The economic reality is the opposite. According to the IW report, Trump's economic policy is disorienting companies, slowing transatlantic trade, and thus affecting not only German firms, but also weakening the U.S. economy. Not strengthening, weakening. The Trump administration's trade and investment strategy, as the National Taxpayers Union describes it, resembles the failed approach utilized by some developing countries in the 1970s. Erect high trade barriers in an attempt to force people to make things here if they want to sell things here, and subject new foreign investment to micromanagement by government officials. It is wishful thinking, they conclude, to believe those policies will work any better here than they have in other countries. That's the fundamental problem. Trump's trade policy is based on an economic model that has been tried, tested, and failed in dozens of countries over decades. Import substitution industrialization, the fancy academic term for tariffs will make us manufacture everything, was the dominant development strategy in Latin America and Asia in the 1960s and 70s. It failed spectacularly. Countries that pursued it fell behind. Countries that embraced trade integration, like South Korea, Taiwan, and later China, experienced explosive growth. The lesson of the past 50 years of economic development is clear. Openness, not protection, drives prosperity. But that lesson is being ignored in favor of nationalist rhetoric that sounds good in political rallies, but crumbles under economic scrutiny. So where does this go from here? I see 3 possible scenarios playing out over the next few years. Scenario 1. The status quo continues. Trump maintains his current tariff regime. Germany and other countries continue pulling back investment. American manufacturing becomes progressively less competitive as input costs rise and foreign capital dries up. By 2028, the United States has fallen significantly behind in advanced manufacturing, green energy technology, and industrial innovation. This is the slow decline scenario. Scenario 2. Escalation. Trump doubles down. He imposes even higher tariffs. Other countries retaliate with their own tariffs and investment restrictions. Global supply chains fracture completely. We enter a 1930s-style trade war that tanks the global economy. Recession, job losses, financial instability. This is the catastrophic scenario. Scenario 3. Reversal. Either Trump moderates his position, or a future administration dismantles the tariff regime. Trade barriers come down. Foreign investment gradually returns. But here's the problem with this scenario. The damage is already done. Companies that have spent years building alternative supply chains aren't going to abandon them overnight. Trust, once broken, is hard to restore. Recovery would be slow and incomplete. Personally, I think we're heading towards Scenario 1 with occasional flirtations with Scenario 2. The momentum of capital reallocation is already underway. Germany's gross domestic product stagnated in the third quarter of 2025 following an earlier contraction, marking the third consecutive year without expansion. That's not an economy that's going to massively increase investment in a high-tariff market. That's an economy that's going to protect its interests, diversify its markets, and reduce exposure to unpredictable trading partners. And America? We're watching decades of carefully built economic relationships dissolve because of a fundamental misunderstanding of how modern global commerce actually works. Let me close with this thought: $9 billion. That's how much German investment America lost in just 10 months. $9 billion that could have built factories, created jobs, transferred technology, and strengthened communities across the United States. Gone. And Germany is just one country. When you add up declining investment from Japan, South Korea, the UK, France, and other traditional allies, the total capital flight from the United States is staggering. This isn't a sign of American strength. This is a sign of decline. The tragedy is that it's completely self-inflicted. We're not losing investment because our workers aren't skilled, or our infrastructure is crumbling, or our innovation has dried up. We're losing investment because our trade policy is chaotic, unpredictable, and economically illiterate. And here's what keeps me up at night. When historians look back at this period, I think they'll identify Trump's tariff regime as the moment when American economic dominance began its irreversible decline. Not because tariffs alone destroyed the economy, but because they signaled to the world that America was no longer a reliable partner, that the rules could change overnight, that investing in America came with risks that didn't exist in other developed markets, and capital ultimately is ruthless. It goes where it's treated best, where it's most secure, where the returns are most predictable. For decades, that was the United States. Increasingly, it's not. The sound you're hearing? That's the sound of capital leaving. That's the sound of factories that will never be built, jobs that will never be created, innovations that will never happen on American soil. That's the sound of an empire in decline. Thanks for watching. If this analysis opened your eyes to the real economic costs of trade wars, subscribe to the channel, hit that like button, and share this with anyone who still thinks tariffs are making America great again, because the data says otherwise.